Alright guys, so I have not done an update video on the markets in a while, but I know there's a lot of anxiety going on in the markets right now with the recent sell-offs that we've seen. I'm going to keep this video as short as possible, but I'm going to be covering what I see in the markets right now, what investments I am looking at to hedge my portfolios in this type of environment, what I see in relation to the economy, how are Trump's tariffs going to impact the economy and the stock market and the bond market, and general fundamentals and principles as to what you should be buying in these types of environments and why. So without further ado, let's get into it. Number one, guys, let's look at the indices. Obviously, S&P 500 and the NASDAQ are super important. QQQ tracks the NASDAQ, and we can see from all-time highs that we have reached almost a 14% discount on QQQ. The S&P 500 is down almost 10% from all-time highs. So both SPY and QQQ are ranging in correction territory. If you guys didn't know, a correction is a 10% decline or more in the markets. A crash is considered a 20% decline. If we look at Bitcoin hitting a high of 109 and now trading down into the 80s, and of course stocks like Tesla have seen a massive decline over the last few months. Nvidia seeing a pretty big decline as well on the higher time frames, and of course those higher risk stocks like Palantir have also seen sell-offs. So the main question is, are any of these stocks good to buy right now? Are there any other hedges we can take on our portfolios to protect our capital and potentially make money to the upside or downside? And how are Trump's policies going to impact the stock market and the bond market? So starting with QQQ, guys, I will say this again, a correction is a 10% decline or more. Currently, QQQ is down almost 14%. We are trading at the 300-day moving average right now, which is also a very good time to start dollar cost averaging, in my opinion. Now, this doesn't mean to go all in on QQQ, but this general area is a good place to start DCAing. We know that QQQ is tech heavy, so this includes a lot of things: Nvidia, Tesla, Apple, Amazon, Microsoft, Google, etc. But when I see this decline more than 10%, this happens on average once every 2 years. So why in my right mind would I not be investing into ETFs like this? The S&P 500 is not quite down 10% yet, so I have not invested personally into the S&P, but once this hits correction territory at 10%, if it does, I will start adding. Could we go lower on the S&P 500 and QQQ? Absolutely, guys. There is no way to know for sure where the bottom is, but again, the only discounts you have are the ones that are in front of you. So in my personal opinion, it is a good time for me to start dollar cost averaging into these markets. If we do end up getting a 20% correction or more on the S&P, that would put us below this internal low here at around $493. This is where I would go much more heavily into the S&P 500 should we get there. So even with the correction that we're having, I still think there is potential for the market to sell off further. Now, this correlates a lot to the policies that are going on with the Trump administration, but it goes farther than just that. Obviously, Trump's tariffs are putting a lot of uncertainties into the market, and that is causing the market to sell off. But there's other more important and bigger things in the market related to interest rates, Fed policies, and the 10-year yield, which is super important. If you guys don't know about that, I will cover it in a second. So starting with TNX, if you guys didn't know, this is the main ticker that tracks the 10-year treasury yield. This essentially tracks the interest rate that the government owes on their 10-year debts. And the higher the interest rate on their debt, the more money they're going to have to pay out. Most of you know that the United States has about $36 trillion in debt right now. So imagine the interest rate payments on this with a high 10-year yield. So it is well known that the Trump administration is trying to lower 10-year yields in order to reduce the interest payments on the debt that they owe. So the Trump administration is working with the Treasury Department. They have actively said that they are going to be issuing less treasuries into the market. So by issuing less treasuries, they are borrowing less money. And in turn, this is going to reduce the supply of treasury bonds in the market. And if you guys know basic supply and demand, if there are less treasuries in the market, there is less supply and the price of treasury bonds will go up. Inversely, the yields will come down. By reducing the amount of treasuries in the marketplace, they're essentially trying to lower the 10-year treasury yield. And for this reason, there are specific things that I'm looking at personally adding into my portfolios to catch this move and try and make some money on this. So two things that I'm personally looking at, if you can see here on the right, are TLT and AGG. AGG is an aggregate bond ETF, which means it has a lot of different bonds within it. But you can see that both TLT and AGG have both broken out of their downtrends. Now, these both track bond prices. So as the 10-year treasury yield starts to drop, the yields drop. What happens to bond prices? I told you they're inversely correlated. So as the 10-year drops, bond prices will start to rocket, meaning TLT should, in theory, start trading higher. I told you we've broken out of this trend line and we are now in the retest zone of this trend line, which is where I am personally adding to my positions, with the idea that as yields continue to go down, bond prices will move higher and eventually target the internal highs that we see here at 101 and eventually 109 for TLT. Similar pattern with AGG, but I would be aiming for the 102 level and the 104 level for a higher time frame target. So when we enter into these kind of risk-off environment where the Treasury is not issuing bonds and we have an administration that's actively trying to lower rates, typically this becomes a risk-off environment, and so investing in bond ETFs like TLT and AGG are a way to kind of hedge your portfolios and essentially make money off of the upside moves while the stock market might potentially be in a slower period. Now, of course, that doesn't mean that you can't invest in the stock market if there are discounts that are great enough for you to invest in, putting your money to work even if you don't see returns immediately. So again, investing in the S&P 500 on 10% corrections or greater, as well as the NASDAQ on 10% corrections or greater, I think are great spots to DCA. If we look at individual stocks, guys, Tesla is a stock that I am personally looking to add for my long-term portfolios. We are down 55% from highs, and we finally filled this gap on the daily chart that happened after the earnings report in October of 2024. So in my opinion, this is a great spot to add Tesla for the long term. We've lost almost $800 billion in market cap on Tesla, and personally, I believe with all the things they have going for them, including energy, Optimus, full self-driving, and the potential investments into their other companies, into Elon's other companies like xAI, gives this company the potential of being worth much more than $700 billion in the future. Now, Tesla is a little bit higher risk than other blue chip stocks. Companies like Amazon are trading almost down at their 300-day moving average. Microsoft has taken out its sell side liquidity on the daily chart, so I think that this is a decent spot to start DCAing as well, though I'm seeing a lot more weakness on Microsoft because it traded below its 300-day and it's actually trading way below it, which to me signals that we might see even further potential downside on Microsoft. Apple is coming close to its 300-day moving average, so you can pay attention to this. Even if we have more downside, if you just add these companies at these moving averages, you tend to get great returns for the future. Google is another one that we're trading below the 300-day moving average, so I wouldn't be surprised to see short-term bounces from these levels, but regardless, this is a great spot to start adding for the long term. Nvidia has also seen a big sell-off. I would definitely say that Nvidia in these areas is a good spot to add as well. However, personally, I am looking for my biggest adds on Nvidia if we can miraculously get below this 90 level and potentially below this 75 level, which is major sell side liquidity for the stock. Now, there are a lot of other stocks that I am looking at. I can't cover them all in this video, but I do alert from my communities whenever I do add things for the long term. If you guys want to join the community for my long-term ads, day trading, option selling, and all other investment strategies that I use, we are currently running a free 3-day trial. There is a link in the description below. But of course, going back to the video, guys, those are some of the main stocks that I'm looking to add for the long term here. Going to the economic calendar, it is a huge week in the markets. Tomorrow morning, we have CPI. I will be trading this live on YouTube for those of you guys who want to tune in. It is absolutely free. Make sure you join tomorrow morning. But CPI is going to be a huge indicator as to what's going to happen in the markets. We will see how this plays out, but I think a very good day trading setup will come from that. And then Thursday, we have PPI, which also should create some big volatility in the markets, and then consumer sentiment and inflation expectations on Friday. One other thing that I do want to talk about right now, guys, is the VIX. We are seeing a push on the VIX that we haven't seen in a very long time. The last time we got to even close to these levels was in August of 2024, but in my opinion, these are great times to start shorting the VIX. I did alert to my community while I was live streaming today that we shorted the VIX at the 29 level, and I'm already up almost 11% on this short. In my opinion, shorting the VIX at levels above 29 is essentially free money. Yes, you are risking times when we will have pumps like this, but they are very short-lived oftentimes and happen very rarely. So shorting the VIX when we have big down moves in the markets is also a way that I hedge my portfolios. Now, very briefly going over day trading today, there was an insanely good A+ setup in the markets today. We had a inverse 5-minute fair value gap after sweeping liquidity to the downside. I was a little bit late to calling this in the Discord as I live streamed today for almost 5 hours, but if you were to enter anywhere in this leg of price, even on this retracement, we were aiming for these equal highs, and you can see that this cleanly delivered all the way up to buy side. And then lastly, guys, there are a few swing trades that I am looking at personally, and one thing I would probably focus on, and again, this is totally up to your own discretion, but I am personally looking at stocks that could potentially perform well in low interest rate environments. I personally think that the Fed is going to be cutting rates more than most people expect this year, all to do with what I talked about before, relating to reducing the interest on our debt, relating to Doge and their task of reducing federal spending. All of this is kind of indirectly supporting the case for lower yields. And so if you can look for stocks that could potentially perform well in low interest rate environments, I think there will be some very good swing trades to the upside when more news comes out that interest rates are going to be lower than people expect. Those specific plays I'm going to keep private to the Discord, but again, do your own research, see if you can find some stocks that will perform well. Best of luck in your trading, guys. Make sure you hit like and follow, and I'll see you guys next time. Peace.